the global economy, or the alternative being signals that either US oil production has begun to turn down significantly, or that there is a significant turn down in Russia's crude and diesel exports. So until one of those things happens, I think that those cuts will in fact have to be extended.
Martha, did you get anything from ministers or from the Saudi delegation on that?
I mean, the messaging that we've been getting since the meeting, I mean, clearly Prince Abdulaziz was asked about why go it alone, why have a voluntary cut instead of a group cut, and he immediately put an end to kind of any speculation or questions that people might have in mind of whether this was initially a group cut that turned into a Saudi voluntary cut, and he said he didn't want any speculation on that this was just something that Saudi was doing by itself, that they were doing it because they want to lead by example, and they were going to correct the market. And so, I mean, and the sequence of the events that happened in the lead up to the meeting was such that we had to talk about a group cut from our sources. That's what we were hearing. And then the prince arrived on a Saturday morning, and he had meetings with several Gulf ministers and Algeria and Iraq. After that meeting, he then had meetings with African ministers, Angola, Nigeria, Gabon, and the talk then started to shift to quotas. And so exactly the details of what happened in these closed rooms, we don't know quite yet, but we know that with his arrival, somehow the conversation shifted.
Thanks, Matt. Just John, coming back to you, what do you think this actually means for Saudi production or exports? I mean, question there from the audience, but we know that Saudi Arabia needs to burn more crude and fuel in the summer to produce power. How do those things all come together?
Yeah, I mean, the OPEC production allocations apply to actual production, not to exports. And given their track record of compliance in the past, I would expect the Saudis to actually reduce production by 1 million barrels a day for the calendar month of July, taking 31 million barrels out of the market. They have the option of deciding whether or not to maintain exports at the same level and simply draw down inventory, or to maintain inventory and therefore reduce exports. They do have that option. They have raised OSPs for July, which suggests that they want to supply less. But it is, I mean, as I say, the quotas apply at the production level, not at the supply level. I would expect, they will either reduce exports or inventories or both. Either way, the market becomes a little bit tighter. I think there's also, just to chip in on the point that you made last, which is one reason why this may have ended up as a Saudi unilateral cut rather than as an OPEC plus group cut, is the issue of credibility. If the Saudis say we're cutting by 1 million barrels a day, the market accepts that means there will be 31 million barrels of oil less in July. If that had been an OPEC plus cut, shared out pro rata amongst the members of the group, you would have known that actually some of the members wouldn't have cut. So the actual cut would have been a lot less than 31 million barrels a day. So I think perhaps one reason for doing it on a unilateral basis is if you really want to send a strong message to the market, it is better that the cut comes from Saudi Arabia than from the group as a whole. And maybe that was one factor in the complex decision making here.
Okay, thanks, John. Dan, what impact do you think this cut and some of the things that John's been talking about, right? The potential for tight markets, maybe for increased prices later on. What impact it has on the U.S. economy?
Well, I mean, energy as a share of the U.S. economy is frankly at a record low. It's something below 5% of total GDP. That's the lowest since EIA began tracking it as a component as a slice of all U.S. output since 1970, right? So on its own, it's hard to have that move the needle. Now, where U.S. administration officials will get concerned is if it translates into something at U.S. gasoline pumps. But even there, over the last year, gas and oil as a factor inside what is demonstrably the biggest U.S. problem economically right now, inflation, has dropped really demonstrably, right? I mean, about a year ago when we were at record $5 a gallon gas here, the weight in CPI for gasoline was about 5%, a little over 5%. That was the highest we'd seen since that peak oil period in 2008, right? July 2008, when we got near $150 a barrel. Since then, it's dropped. Over the last 9 months through March, it's down to about 3.3% as a weight in CPI. So it's diminishing. And then you look at there's been very little pump price response here. We've been at $3.50 roughly a gallon for a month straight now. We're down 30% from last year's record high. So it's hard unless you really see these expectations for the crude price to gain on this, which has not yet lived up to expectation. To translate into something that might be seen as threatening, which is why I think you've not had a real chest-thumping response from the U.S. administration on this. They've said they don't like it, but they haven't made a huge issue about it. Anthony Blinken is the Treasury, not Treasury Secretary. That's who I care about the most. But the Secretary of State is headed to Saudi today, and he's likely, as part of broader talks, to express some unhappiness with this. But there's not a lot of sleep being lost over this, I don't think, at this moment.
Yeah. Thanks for that. So the IEA, International Energy Agency, OPEC itself, many forecasters expect fundamentals to get tighter as the year goes on because of because of global economic growth, really. Those forecasts are sort of predicated on 2.6% growth for global GDP. And I mean, I wondered how that looks to you, day in, day out, looking at the economic indicators, looking at the strength of the U.S. economy. What does that look like to you? Does it kind of line up with what you're seeing in terms of what?
Well, globally, that squares, with what the IMF's most recent forecasts were for global growth, which is about 2.8% for the year. That's achievable. Now, the big question mark really hangs around what central banks are doing to slow their economies in the United States and Europe in particular. You've got chunks of Europe that are already in technical recessions. Germany, big industrial economy and consumer. China, I think, as John mentioned, has had a very lumpy reopening. Quick start in Q1, but more recently, data has largely underperformed. We're expecting to see some import and export data. I think it's tomorrow from China that are both expected to be actually contractionary. So that's not helpful. And then there's the outlook for the U.S. economy itself, with 500 basis points of credit tightening by the Fed so far since March 2022, at least in market views, 25 basis points more, possibly even more than that. before the end of this year. Maybe we get up into the mid fives. You've begun to see credit growth slowing, particularly on the commercial and industrial loan growth so far this year is negative. That's a big conduit for financing into the energy space. And then the two big components of the U.S. economy, manufacturing, services, the much larger. You look at the most recent ISM survey data out in the last 4 or 5 days. Manufacturing, contracting for 7 straight months in a row. That's something we haven't seen since 2008. And services in the most recent month, barely above the 50 mark that demarcates expansion and contraction. And if you look at its behavior, that's 3/4 of the U.S. economy. Over the last 3 months, outside of the COVID disruptions, that's also kind of the weakest run on the services slate since 2010. So there's lots of debate about whether we're going to get a soft landing here, but no one's expecting really expanded growth from here, despite the outperformance against expectations the U.S. economy has delivered so far this year. 339,000 jobs created last month. Very, very little let up in demand for workers. So those are all supportive, potentially, for the tighter conditions that maybe they're predicating some of these forecasts on.
All right, thanks, Dan. Okay, we'll get into a few more of the questions from the audience, and for everybody who's watching, who's joined us for this, please do send us in your questions. We've answered a few of them. One is we've talked about the OPEC quotas and how those will change, or the targets will change. Do you think that even with the cuts, OPEC members will still fail to meet their production targets? I guess that's one for you, Dean, on that. As in, they were underproducing anyway, right? They weren't even meeting their targets. If the targets are revised, what are we going to see? Are we going to see better compliance? Are we going to see more realistic matchup between targets and actual production?
I think you're right, Simon. I think we will see a more realistic matchup between what they can produce and their quotas. I think during the redistribution, I mean, the idea to lower the baselines for Nigeria and Angola and a few others, if you look at the numbers, the cut is very aggressive. So to jump from 185 to 138, if I remember correctly, the figures, that's a big cut. That's a big cut. But even when redistributing the baselines, revising the baseline for the members, OPEC decided to use the highest production numbers for the past 6 months. So, which means that in other months, during the 5 other months, countries were really struggling to produce even that. So that gives you an idea of what about the state of the industry in some of those countries. I mean, it's of course red tape and underinvestment, probably to a certain extent energy transition, because majors were focusing on other areas, etc. But interestingly, there is a couple of caveats in the final OPEC statement. A few asterisks were saying those figures might be revised, and we've seen in the past a couple of examples when all of a sudden a couple of countries are getting different quotas to what was discussed during OPEC meetings, and that happens just all of a sudden, like in the middle of January. People start gossiping that one country has seen its quota increased or decreased or whatever. So that's something that we should be probably watching in the next few months quite carefully, how those figures, whether they'll change officially or kind of course they'll change officially. I mean, will the change be done in a quiet way, or I mean, there's going to be some public statement or something?
All right, thanks, Tim. Another question here, and one that, a topic that we haven't raised yet, which is, the impact of sanctions from many Western governments on Russia. Do you think that the OPEC Plus started to crack at this meeting because of the interests of because the interests of the Russians and the Saudis are pretty different? And I guess another element to that question is the increased Russian sales to Asia, which is displacing some of OPEC's sales. So, I mean, I know there was some reports before the meeting of tension between the Saudis and the Russians. Was that a factor?
It is a fact. I think. I mean, they share one common interest. They want higher oil price. That's kind of the most important thing. Then, of course, traditionally agendas have been completely different, political agendas. All of a sudden, we've seen a rapprochement between Saudis and Russian, particularly during the Biden administration. But of course, on a pure technical oil level, what has been happening is that Russia has been taking an increased share in Saudi previously beloved and premium markets, such as China, India, Asia, the real growth markets, because Russia has been discounting its oil by a significant amount because of the sanctions. To be honest, I think the Saudis do understand that the Russians don't know exactly themselves how their exports is going to pan out, because I mean, originally a year ago there was a kind of cowboy approach. Oh, oil will go anywhere in the world, and it's only going to be Europe that's not going to buy Russian oil. That was sort of the idea in Moscow. But when the shipping ban was introduced and the insurance ban, Russia quickly realized it doesn't have the tankers to export all of its oil. And this is when real problems started. So there've been months when Russian companies didn't know themselves how much they would be able to ship. And yeah, it has been a very quickly changing environment when before introduction of every cap and every regulation, there've been huge fluctuations. And I think it's still continuing, quite honestly. But the bottom line, yes, Russia has taken a big share of previously markets kind of supplied by the Gulf OPEC members in Asia. And instead, what the Saudis and the UAE and Kuwait have been doing, they've been supplying European markets, which have become premium markets these days. Kind of the situation flipped completely.
Yeah. Okay, thanks for that, Dima. John, what are your thoughts on that? On how uncertainty over Russia and the sanctions and the changing kind of flows from Russia into Asia, how they factor into all of this?
Yeah, I mean, I agree with Dima that effectively the consequence of the sanctions is that Russian oil is flowing into Asia rather than Europe, though those Asian markets were the large, fast-growing markets that Saudi Arabia and the other Gulf producers had prioritized. So that is a little bit uncomfortable. At the same time, the Gulfies have been able to increase their exports to Europe. Okay, it's a smaller, declining market, but I think there is a realization that this is probably a short-term problem that could be reversed a year, 2 years down the line. In the meantime, the Saudis and others are continuing to try to build out downstream distribution. So there's continued investment in Asian refining sectors. There's a desire to sort of move down to integrate downstream and to get guaranteed market access. So yes, in the short term, I think it's probably a little bit uncomfortable for the Gulf producers, but I think it's probably not too much of a problem. Going forward, there is the question, and this is one of the big uncertainties, is sanctions enforcement. At the moment, enforcement has been fairly relaxed. Russian oil has continued to flow relatively unimpeded, as Dima said. There have been hiccups in terms of paperwork, but they've mostly been smoothed out, and the oil is flowing. That has kept prices down. There is a question about whether or not at some point, the United States and its European allies might try to tighten those sanctions. On the other side, there is growing concern that European maritime services firms are increasingly losing market share, that insurance and other maritime services that would once have been provided from London and other European markets are increasingly moving to Asian providers. And there is, I think, anxiety that what happens if that goes on for too long? Is that loss of business permanent? What does that mean for, European maritime services businesses? So there is I think that discussion is clearly happening in the background. We've seen it surface a few times in the media over the last couple of months, often expressed in terms of anxiety that the insurance standards are not as strict, that there might be, that this could increase the risk of a catastrophic maritime spillage. But I think the unspoken thing is also that there is a real concern about, the loss of revenue and the loss of market share.
And Simon, if I may just jump in quickly, even besides the maritime industry, what's happening is that the currency of the trade has been a non-dollar currency, right? I mean, a lot of things migrate towards the yuan and other currencies. And to be honest, people in Washington and Brussels realize that their visibility, given that nothing is going through kind of Western banks, their visibility about what's going on is becoming more and more limited. And kind of knowledge is key, and this knowledge now is very, very limited about what's really going on between Russia, China, Russia, India, etc.
Thanks for that. Question for you, Dan. There's sort of the flip side of higher pump prices, higher oil prices, is the boom to the US energy industry. How do those two things sort of play off against each other? You mentioned earlier that energy was a smaller part of US GDP than it has been for a long time. But how do those two things, balance out? Would you expect higher oil prices to mean more jobs, more growth? I mean, we've seen record US production. So
right. Well, you have, right. I mean, if you look at the natural resources and mining sector of employment, it's gained, pretty demonstrably over the last couple of months. It's down still by a third, roughly from its peak back in 2014, when there were more than 900,000 people employed in the sector. It's down to about 645 or so right now, and it's one of the few sectors that is still not fully recovered from the post-COVID dive that we saw in 2020, and total U.S. employment is already fully recovered. So there's quite a bit of ground to make up there. It's interesting, right? I mean, if you look back at just pure rig kind of work, oil and gas drillers, derrick operators, roustabouts. In 2014, there were about 183,000 of them in the United States employed. Particularly the derrick operators and drillers, we're getting an above average wage, annual wage. Roustabouts, maybe not so much. Between the two of them, as of 2022, there were, that were about half that number, below 100,000. And it had been even lower, obviously, at the beginning of COVID. But you'd seen, what happened, when in the first half of the teens, the rising oil price, brought that fracking boom, that brought a hiring boom, that eventually brought a nosedive in price and layoffs everywhere. So whether that cycle gets repeated, I don't know. But and also, if you look at just the debt ceiling deal that was reached just over the weekend to avert a big problem with the U.S. economy, but there was expedited and energy permitting involved in that. So, particularly on the pipeline front, which then probably instigates, more drilling and other activities. So you could, I would expect, the data I was just citing about, is about 10 months old on the number of derrick operators and so on. That's probably back over 100,000 now, based on what we've seen in the sector growth, but it's got a long way to go. But you could see upside in employment there.
All right, thanks, Dan. John, taking this into account, the the $1 million barrel per day cut from Saudi Arabia, the revision to the baselines, the fact that there'll probably be a little less oil than expected on the market last year, if the production curves continue. What's your take on fundamentals for the second half of the year and beyond?
Well, I think we have to start by saying that in real terms, the price of oil is quite close to its long-term average. The real price of Brent is just slightly below its sort of post-2000 average once we take inflation into account. So, what you've seen is quite a significant deterioration in the fundamentals over the last 6 months, higher supply, lower demand than was forecast. But so far, OPEC, led by the Saudis, OPEC Plus, has been able to offset a lot of that and has managed to sort of stabilize the price at this level, which is pretty high, given that we're in a sort of business cycle downturn at the moment. Going forward, I think the key question is whether this is effectively a soft landing. The manufacturing and freight sectors are clearly effectively in a recession, but the services side of the economy, which is much larger, is not in a recession. It's in a sort of period of sort of sluggish growth. The question, I guess, going forward is, do we see services continue to grow and then manufacturing and freight demand to come back? In which case we start to see a cyclical upturn, and that then tightens the oil market quite a lot before the end of 2023, and it would certainly tighten the market in 2024. Or are we actually going to see that the weakness of the manufacturing sector now increasingly spreads across to services? That means that we go from an industrial recession to a whole economy recession. And we see a much lower oil consumption trajectory as a result. So the key for me is, I think OPEC has done everything that it can to arrest the decline in prices. There are significant production cuts in place, and that has kept them pretty close to average. What happens next really depends on where that macroeconomic cycle goes, and as Dan can expand on this better than I, but the honest answer is we don't know. The economy has slowed quite a lot, but inflation is proving quite sticky and quite persistent, and there is an open question about how much further interest rates might have to rise to sort of snuff out some of those inflationary pressures, and crucially ensure that inflation doesn't take off again. Because one of the specters that I think really haunts policymakers is if we start, if we pause interest rates or we cut them in an economy that is operating quite close to full resource utilization, is there a risk that 6 months later inflation starts to accelerate again, and then we have to raise interest rates very much higher? And I think that is something that they are deeply anxious about, because that could be extremely disruptive for the economy. But Dan, this is Dan's.
I'd agree with that. I mean, at the ECB, at the Fed, at the Bank of England, the primary concern right now is inflation expectations, making sure they get that back to 2% within a reasonable time, and consistently beating back against these market expectations that we're going to get to a peak level of interest rates and start cutting right away. They're not going to blink and start cutting interest rates until inflation responds in a way that they really intend it to. While headline inflation is down, very notably from where it was a year ago right now, those underlying sticky inflation measures are really persisting. The core rate that the Fed watches is still at 4.5%. It's gone sideways since the end of last year. We'll get another reading on that in about a month. We're going to get a CPI reading in a few days' time next week, just as Fed officials are sitting down for their June meeting, which could easily prove to be a pretty hot one. Again, the pressure there is no longer coming, from your guys' patch. Really, it's coming from it's coming from services and things that people are being paid to provide, and therefore wages are growing at a rate that's not consistent with a 2% inflation target. So there's something's going to give, and they're determined to make that. Fed officials expect. We saw a 0.3 percentage point increase in the unemployment rate last month, and even with 330,000, almost 340,000 new jobs created, the Fed projects that that's going to get to about 4.4% before the end of this year. That's a growth rate in the unemployment rate that is always been associated with the onset of a recession. So if those forecasts live up to expectations, you will see a U.S. recession, the world's largest economy in recession by the end of the year. What magnitude of downturn that may be, anybody's guess. It comes with a caveat that, of course, a lot of people expected a recession to be very apparent right now, and it's clearly not.
Thanks for that. Couple of last questions, and then we'll wrap up here. This one for you, I think, John. Does the OPEC Plus agreement, or how would it impact U.S. plans to refill strategic petroleum reserves?
I think in many ways the SPR play is probably fully tapped out. The administration released a very large amount of crude last year, and it was to some extent able to offset production cuts by OPEC and loss of barrels from elsewhere. That did, that blunted the rise in oil prices. It is a sore topic amongst oil producers. I don't think that you will, or indeed could, see a similar large-scale release. I mean, the problem with the SPR, and it's a little bit like when you have foreign exchange reserves, in order to maintain the credibility of the reserve, you need to avoid it getting anywhere close to zero. The closer it gets to zero, the more that people say, oh, well, it's going to run out. So you need to keep a very large number of barrels on hand. You have already released essentially a third of the oil that you had in the reserve, prior to Russia's invasion of Ukraine. So I don't see a similarly large release again, which means that that takes that policy option a little bit off the table, and it does mean that OPEC has a lot more. It means that OPEC is very much in the driving seat in a way that it perhaps wasn't so much in 2022.
Thanks, John. One for you, Maka. The UAE came out of this with a higher production quota. Can you tell us? I mean, was the UAE the winner here? Is the UAE going to pump more? What's the thinking?
I think it certainly was the winner, and I think they have ambitions to raise it even higher and pump much more. I mean, if you look at the numbers, they got bumped by about 200,000 barrels per day. The UAE has a capacity of over 4 million. They're looking to raise that to 5 by 2027. And so for them, I mean, the Emiratis would very much like to be producing more. They would very much like to be exporting much more. I mean, when you look at the revisions of the baselines that happened and the quotas, like Dima was saying, if you look at the numbers, a lot of those African countries, Nigeria, Angola, were underproducing, and even the figures that they were lowered down to, reality might even be lower. For the UAE, it's quite the opposite. What it was bumped up to, in reality, it can do much more. And it has that ambition of doing much more. Of course, there's always kind of the caveat attached to that this year is that the UAE is hosting the COP28 climate summit. And so there's this kind of contradiction in terms in it, you know, wanting to produce and pump much more and export much more oil while it's hosting leaders to talk about, you know, renewables and alternative energy and transition. And so I mean, what we've been hearing basically is that, yes, they want to produce much more. They want to export much more. It's probably going to happen starting next year, not this year.
Thanks. And then finally, what's next for OPEC and OPEC Plus? When do they next come together?
So they're meeting again in November, I mean, I think when you look at what their strategy has been so far, led by Saudi Arabia, is that they had these dramatic cuts in October, which caused very vocal animosity with the US. That seemed to work for them. And ultimately, they were proven right in terms of market fundamentals. They had the surprise voluntary cuts in April, which kind of jolted the market upwards, but was unable to maintain the price that they probably are aspiring to. And now with this latest move, they had this additional voluntary cut for the Saudis that kind of raised prices a bit, but like I don't think it had the dramatic effect that so far that they were expecting. So it's going to be interesting to see what they still have up their sleeve to balance the market, as they say, or make it reach a stage where prices are where they aspire to.
Okay. All right. Well, thank you very much, Maha, Dima, Dan, and John. Thanks for a great discussion, and thanks to the audience for tuning in for this and for some great questions. We'll end it there. Okay, thank you.
Thank you, Simon.
Thanks, Simon.